Welcome back to this very special show. On our last program, we had Ramdev Agarwal, who, if you remember, had said that most people who watch this show or watch business television won't be able to make money on their own, at least not consistently for long periods of time. And that's the trick in the market, in the stock markets, to do it consistently. So we decided, why not talk to a fund manager who actually does this for a living and try and understand how they do it. Because at the end of the day, if you are to give your money to fund managers or money managers, you need to have the conviction and a bit of understanding as to how they do it. The guest on my show today is Kenneth Andrade, who essentially oversees the entire investment practice at IDFC Asset Management Company. Kenneth, thanks very much for your time. Great to have you here. So I just want to start by asking, people have basically called you the mid-cap mogul. I don't know how apt that title is, but it kind of, I wanted to bring that up because I want to tell viewers that you essentially are someone who's known at picking stocks, right? You're hands-on, you evaluate businesses, investigate, and if you're convinced, you decide to own some of those businesses. Just very simply for our viewers, tell us how you do it.
Okay. We're fortunate to be in a market like India. It's fairly diverse. You've got close to an investable number of companies of about 800 that's there in the entire system. You've got companies from virtually every industry that's actually listed. Okay, so participation in Indian equities, is fairly broad-based. Within that, you have to shift through finding out good companies. So we, over a period of time, if you go back to the decade, 2 decades or 3 decades, as long as markets have been in existence, good companies have survived multiple economic cycles and have grown stronger as the time evolves itself. And that necessarily has to be the focus. Okay, so good companies have always made money for the investors. Irrespective of the underlying macros or irrespective of the underlying economy, and that's essentially the focus of investing that we at IDFC practice. Now, what defines a good business? A good business essentially needs to have market leadership, okay, or has to strive for market leadership. To strive for market leadership, it has to have the characteristics of what a leader should be. Okay, a great product or a great cost curve. Okay, so if you have a good cost curve, you're going to be in business for an extremely long period.
What do you mean the cost? What does it mean?
You just need to make your product available at the lowest cost possible, or you have the lowest cost structure in the entire.
So you are able to produce the product very cheaply.
Essentially so.
At least compared to the competition.
So if you're going in through a rough economic cycle, your profitability gets squeezed. But if, as the lowest cost producer, if your profitability actually gets squeezed, the rest of the industry is actually making a loss.
Sure.
Okay, so you come through the next cycle with a better balance sheet. Okay, so you don't have too much of leverage to survive that, and you just improvise your entire economics of doing the same business.
Sure.
Or you have to have a great product. Okay, that essentially means that you have to have pricing power on the entire business.
Sure.
So these are qualitative aspects of how we try to look at each of our portfolio companies, and the derivative of this is essentially the financial parameters. Okay, the financial parameters effectively represent the strength of your business.
The final outcome in that sense. But it's actually interesting. What do you start with? How do you screen companies? I mean, do you always get ideas by looking at the screen of what you call investable companies, and then you will screen them by some financial parameter, and then you investigate further? Or is it the other way around? You come across a product. It could be actually both, but what happens most often?
I mean, it's physically impossible to look at 800 companies and know each of them, the dynamics of each and every company. But there is always an opportunity that you get with particular industries, wherein the entire industry is going through a massive crunch in terms of numbers, and then you'll have one company that actually makes a profit. Okay, And this has happened multiple number of times that you actually put it together. So if you go back into 2000 probably the most recent examples have been in 2012 and 13, where the entire markets actually collapsed themselves. There you essentially need to look for market leadership available at dirt cheap valuation. So there you got market leadership and you got your price which was right. Okay, how do you define market leadership? Obviously, the company's been growing at a rapid rate. He's been gaining market shares, and all of that is in public domain. How do you screen for valuation? That is also there in the public domain. Okay, so you probably need to look at a constituents of both of these two things together and actually put it together, and that's what the outcome of the portfolio will be.
But those are extremes that you described, right? In 2013, late 2013, maybe the financial crisis and the fall after that. And those were what gets described as once in a lifetime buying opportunities. And then the returns, you don't have to wait for 10 years. I mean, they came very, very quickly if you bought at the right price at that time. But in a normal market, right? I don't know if this is a normal market we're in right now, but in a normal sort of situation, what would, how would you work it out in terms of finding what to look at?
This is a very normal market. So if you have effectively put it all, if you try and put it together, there are some companies which are going through an economic downturn in their specific industries. Okay, and if you're going through an economic downturn in those specific industries, just look at companies that are extremely profitable or extremely large and putting pressure on the competition.
Okay.
And that's where you actually come together.
Okay.
So in a way, you would have to look against the tide to try and identify long-term structures or cyclical downs in respective industries. Try and aspire to look for companies with market leadership. Okay, and do not take too much of financial risk on your book. Now, financial risk is a question that is a parameter that very different investors describe differently. To us, we do not like companies who continue to expand their capital base. So you do not like leverage on their books. Okay, so we prefer a company at the bottom end of the cycle to be completely debt free. So I'm not buying financial leverage. I'm not buying companies which have got an enormous amount of debt. What I'm buying is just a business which is going through a cyclical low.
Downturn. Right, but it's still doing well. That's the idea.
Well. And the idea is that if my environment actually improves itself, and we're not really trying to time the improvement of the environment, but it might come in 1 year, it might come in 2 years, it might come in 5 years. But qualitatively, these businesses become much better over the longer the cycle goes to the downturn.
I mean, I guess the entire market is your playground right now, because I mean that's what's happening, right? In most industries, generally the industry isn't doing very well, but there are bright spots.
I think this is not a market where any market, I mean, you go back to the financial meltdown, and I remember this statistic, when markets actually melted down in 2009, you still had 12 companies out of the BSE 200 that closed the year with a positive gain. Okay. Were you really able to identify an opportunity at that point in time? Okay. And just to put an example, towards the end of 2008, you had India's largest two-wheeler manufacturer, okay, trading at a 5% dividend yield, and you had one of the small contractors trading at a 17 times earnings, and had a negative cash flow. Okay, so if you put these two parameters together, or if you put these two companies together, the argument would be both were working in different industries. But as an investor, what do we try to do? We try to pick capital efficiency. We're not trying to buy industries out here. Okay.
Sure.
We're trying to look for a return irrespective of the industry that we invest in. And a 5% dividend yield on India's largest two-wheeler manufacturer and a 17 times price earning multiple on a company that continues to expand balance sheet or continues to put more money to work every time. I think there was a big disconnect in valuations there.
So the bet was obvious.
Okay. The bet was obvious, but it wasn't very obvious at that point in time. Okay. So let's check back to the characteristics. What makes a good business? Largest in the business, cyclical downturn, is paying you back money. Okay. So parameters, what's a good business? Once you've been able to identify that, I think.
But do you always go with market leaders? Is that a rule?
I don't think it's a rule, but effectively, if the market leader is not really losing market share, okay, he continues to gain market share. Let's look at it from an industry perspective of paints. Okay, there as an industry, you effectively hold 50% of industry leader has a 55% market share, but as quarterly numbers go through, okay, or the yearly numbers go through, or the last 5 years have gone through, he's incrementally gotten higher market share. For an industry leader who's large, is getting incremental market share.
Yeah, it's getting bigger.
He's getting bigger. He's 3 times the cash flow of the entire industry itself.
Yeah.
Okay, so maybe you may not necessarily need to parameterize it, saying that the largest is the best. You have to look for companies who actually challenge the market.
Who are in a dominant position and they're actually expanding that dominance, right?
So that goes to the second level of it all. You either have to have a dominant franchise or a product, or you either have to lead the industry with your cost. Okay, that's when you have to tear down to probably the smaller companies, or that's where you always have to have keep looking out for companies who are actually challenging the leader. And you would get a number of these companies that will come through.
Okay.
But when you're looking at a downturn in an industry, or if you're looking at a cyclical downturn in a business, I'd rather go with the largest rather than try and play with some look at it in
up and coming player which might or might not succeed.
May or may not.
How do you, so for example, this particular company, the largest paint company that we're talking about, Asian Paints, how do you assess the valuation? What is the right price to pay? How would you do it?
Okay, characteristically there are 2 different things to look at. One is where do you enter your company, and then how long do you want to participate with the company. So valuations is when you essentially try to put the portfolio together. So today if you ask me in some part of the market, okay, valuations are extremely expensive. So does that necessarily mean that I continue to add on to these positions? I may not. Okay, so I need to deconstruct some part of my portfolio. So portfolio management, at least portfolio managers have the advantage of having you can diversify your portfolio. So our concentration is how do I create the next round of companies that would actually dominate my return profile of the portfolio, and not concentrate on something which is already in motion.
Sure.
Okay, so we have our top 10, then we have the second 10, and then we have the third number. So typically portfolios in the asset management business, on the mutual fund space, we run about 30 companies out there, and every portfolio manager has got its own style. I think what we try to deliver is let's take companies from number 11 to number 30, and let's see how we can identify the next round of industries.
But for a viewer who's not got that, in a way, constraint, right? It's not exactly constraints the way you do things, but it's got a binary choice of whether, okay, it's a great business, it's a dominant business, it's growing, and I've got to decide whether it's the price is worth paying or not. How does he do that? What would you tell them?
Don't look at the obvious. Now, you essentially also told me that you just mentioned that how do you look at Asian Paints from a valuation metric. But as I said, don't look at the obvious. There are a number of industries which are actually going through a cyclical downturn. Okay, and there you can essentially spot companies out there. If I look at the soft commodity space or the agricultural space today, I think there are 2 or 3 businesses out there, okay, where there are particular companies which are the only profit-making companies in their industries. Okay, and there are 2 or 3 businesses out there which are only profit-making companies in their industries, and they are by far also one of the larger businesses out there. Okay. Do you have the patience to actually ride through that entire cycle? Okay. And that's where you tend to diversify your portfolios away from.
So then, in those kind of businesses, any price is the right price to pay, because that's the only choice that you have. If you want to participate, you think the sector is going to do well and the business dynamics are quite favorable, then that's the only choice.
Traditionally, we look at valuations from a price to earnings multiple. What happens if the denominator in the industry doesn't exist? So what if earnings in the industry doesn't exist?
Sure.
Okay. Then if the earnings in the industry, we probably need to use another parameter to defining whether the valuations are right.
Sure.
Okay. So how do you define that entire parameter? And these things will differ from an industry to an industry context. So there's no one rule that fits all companies here.